Welcome to Community CPA YouTube channel. Last week, I had a mid-year tax planning session with one of our small business owners. The gentleman is a manufacturer owner with a healthy profit margin for the past 25 years. So the business goes very smooth. Every year is pretty large profit margin. So the couple who owns the company are in their late 50s. So they have no children and they're with me and talking about how to move the business forward with them coming out as a retiree. So for this business, it has been in operation. For this particular business, it has been the operation norm to struggle with labor shortage. So it is always the same issue they have is labor shortage. They always need to hire. If they retire, the worry is about the labor. So they cannot just lose the skilled workers and not keeping them. Otherwise, the manufacturer is not going, the manufacturing is not going really well. This is the reason why we were in the conversation for talking specifically about employee stock ownership plan. So this webinar, we will explore the very basic of employee stock ownership plan. Folks call it ESOP. So you hear that term, right? ESOP. We are an ESOP company, and they are an ESOP company. So what is ESOP? ESOP stands for Employee Stock Ownership Plan. So in the next 20 minutes, I'll explain ESOP in such a way that the small business owners would understand. If you are considering utilizing this tool to retire and also maintain control over the workforce, then the webinar is going to open your eyes. Now, what is ESOP, right? So a ESOP is a kind of retirement plan that the company can set up for their employee. For example, a company can set up a 401k plan, right? So we are familiar with that. 401k plan is a retirement plan. Company can also set up a cash balance plan. That is a pension plan. Company can also set up a ESOP. That is a employee retirement plan as well. Let's explain to you. The employee will get ownership in the company. Instead of cash they got from the 401k plan, kind of the profit sharing money, the employee are getting the shares of the company. So in practice, the company set up a trust. So the company, this manufacturer will set up a trust. The trust is called ESOP. It's an ESOP trust. This ESOP buys company stock from the owner. So the owner owns 100%, the ESOP buys 100%. And then employee will gradually and qualify for shares from this pool of shares that ESOP trust bought from the owner. See how that works, right? Of course, this setup is governed by a specific tax rules. It is called IRC 401A and IRC 4975. So now you kind of understand the ESOP, right? It is kind of in the same category like your 401k, your cash balance plan. Then you have this ESOP. And the employee becoming the business owner with time, with qualification. Maybe they have to work here for 3 years, 4 years, 5 years, however they got it, right? So there will be rules and regulation you set with the ESOP so the employee knows how many shares they get distributed. So when they retire, instead of retiring on the cash amount, they are retiring on the shares. So if the business is going great, then they will be so wealthy with the number of shares they own, and they cash it out to their retirement saving account. So that is our ESOP. Basic ESOP transaction flow, like what are the things we need to do to become an ESOP company. So step number 1 is feasibility and evaluation. Company do analysis to make sure the cash flow supports the ESOP obligation. Okay, then, of course, to support ESOP obligation, then also we need to know how much the stock worth. So there would be an independent valuation to set the fair market value for the shares. So we can sell the shares to ESOP. This feasibility and evaluation is really important step. It's actually the biggest step in this 4-step transaction flow. So normally the company, just like this business owner come to me and we talked about the business, we know their business, and we talk about the possibility for ESOP, but the conversation landed where, okay, let's get the evaluation done, then we do a feasibility study. Let's look to see whether it can support, the operation can support a leveraged ESOP, which means that my client want to take $10 million from the ESOP trust. Then the ESOP trust, it will go borrow that $10 million from a bank and collateralize that on the ownership of the company. So we'll sit the shares inside of ESOP, and the employees will qualify for that, slowly taking the shares to each one of the employee. So that is the feasibility evaluation step. Number one. Step number two is ESOP formation. Company adopt a ESOP plan and a trust designated to meet the RSC 41, those kind of requirement. So that is a formation. Obviously, it's done by legal team to get that ESOP formation done. Then the number three, once ESOP is there, valuation already existed. So let's say it's valuated at 10 million, then your financing and the purchase would follow these dollars. So ESOP will borrow from the bank, then pay the money to the shareholder. So 10 million borrowed from ESOP, but that 10 million is actually paid to buy the shares into ESOP. So the shareholder, my client, would get a $10 million for selling all of his shares. Okay, company guarantees the loan, of course, with the bank using the ownership of the company. And the ESOP uses loan to buy, basically send the money out. So on ESOP books, and it has the shares. Those shares are put in the holding account because it doesn't belong to any employee yet. But then the other side is the liability. So this liability will be paid back by the feasibility study because, if you're going to do a leveraged ESOP, and then you will need to make sure the profit is enough to pay for the finance charges and all that. Those are all tax deductible, by the way. The last step, which is forever step, is ongoing allocations and exits. So each year the company will make contribution and are used to pay for the loan, right? The shares will then be released according to the documentation, how the ESOP was set up, to the employees as a compensation. When the participant terminating the employment, when your employee done with the company, then the distribution, of course, is in shares, but it will be converted to cash to give to the employee based on the valuation of the company. So those are the things. You see how the ESOP works. Basically, it's a vehicle to move ownership from original shareholders to the employees of the company. And this process, the employees don't have to come up with money right away to pay to the owner. The employee can take their time to earn the ownership, and there can be a bank in the middle to finance this deal. So that is kind of the transaction flow. So when ESOP works well, and the ESOP, there's a lot of failed ESOP, and I will be honest with you. A lot of ESOP get set up and it got going for a year or two and it just failed because the feasibility study wasn't really right on. So, or maybe situation happened, so ESOP, becoming none and void, then everything will be taxed and whatever it went to ESOP. So when ESOP work well, in that case, the company must have consistent earnings and a cash flow to service the ESOP debt and the future repurchase of obligations. So it's really, it's asking the company to be consistent with good earnings and cash flow. Sufficient employee base is also important because ESOP is so highly regulated. If all of your qualified employees are actually relatives or related parties to the seller, that would not work. So this will invalidate your ESOP. So you need to have sufficient employee base and a payroll, so to make the ESOP works the original purpose, which to have your employee owns the company. So the ESOP contribution deduction limits are based on covered payroll. So covered payroll means that the people who are inside of the ESOP, how much can you put into the ESOP is related to the covered payroll. Owners who are willing to share equity and share some of the information with employees can do ESOP. The more private business owners doesn't really want employee to know too much of anything. That is not a good candidate for ESOP. So what I typically see in the ESOP candidates are the business owners who really are for the employees, and they want the business to go to employees who are here work for them. And in another scenario is that in my client's case, they don't have any children. Of course they have nieces and nephews, but they don't have direct child that to take over their business. So the employees who work with them for almost 20 years, and they care about them like their family members. So to move the shares to the employees, and plus they always have a labor shortage, that become a very important reason why they want to go on ESOP. So you see how the purpose-driven ESOP can be. So my client want to sell the business to ESOP, then ESOP start giving shares to the employees that worked with them for so long. Comfortable with ongoing fees is another thing for ESOP. If you are a business owner and thinking, yes, I want to get onto ESOP, and I am all for employee ownership kind of plan, and then you need to know that to get the ESOP established, we're talking about $50,000 to $100,000 one-time fee. And to get the ESOP maintained ongoing basis, that is $10,000, which is minimum. I want to put the fee out here so you have a quantitative concept for whatever tools you are deploying and what that's going to cost you. But you may say that, well, if I pay that much fee, what's the benefit to have ESOP? Obviously, ESOP is saving a lot of taxes for the owner, and also delay the taxes for your employee until they retire. So tax benefit, it is absolute. There's no argument about that. But what you want to do is to make sure ESOP is really spiritually in line with what you want to do. One is the ESOP do not fit for the company. A lot of small business are S corp. The S corp a lot of times are the owners and with a couple of employees, so the basis of the payroll is very small. So, and especially the basis of the employee might be the owner or owner related people. So they have very few non-owner employee. But in this case, it runs really borderline, so can be hard to satisfy the Section 409 anti-concentration rules. So there is a possibility your ESOP status would be invalidated. So they will consider you have too much concentrations on the owner, so that is not what intended to be. The cost and the complexity of setting up, when we talk about setting up, I talk about the feasibilities and evaluations, that just can become a headache, right? And your valuation is literally annually because that is how you distributing your shares out. So those kind of things need to be part of your operating norm. You need to budget for it. If you don't have that budget, it is not a fit, right? Unpredictable profit annually, that's really a monkey wrench to the operation and to the ESOP setup. If your revenue is really unpredictable, then you're not leveraged ESOP candidate. So owner unwilling to share company information, that's just the first blockage to go on ESOP. So you would not want to be a ESOP company because you're unwilling to share the company information. So how ESOP compared to third-party sales? So, my clients, they want to exit their business. They're already in their late 50s. So what if someone just come up to them wanting to buy the company outright instead of them thinking about the ESOP option? Of course, the difference is that when you have an ESOP, the company is sold to trusted employees, right? You keep the company culture, the employee benefit, financially because they have a deferred benefit coming up when they retire. Management can often stay in place retain that control because the employee has so much to look to because they are a owner of that company. So of course, the ESOP, when you make ESOP, then your selling is based on fair market value because you got valuation. So it is not like you're gonna sell on the premium, people pay you 3 times of your fair market value. Does that happen? Yeah, it could happen. But in ESOP, it's become very straightforward, right? It is the fair market value, then you go with it. So there is no premium to talk about. But if you sell to the third party, just depends on who is your buyer. You could end up with a premium price, sell you 20 million, to give you 20 million to buy your fair market value 10 million company. That's very possible. So those kind of third party strategic sales, they're not ESOP sales, they could have a chance to sell a lot more than what ESOP fair market value become. The buyer, and it could be your competitor, could be your PE acquisition people, and they take a control right away. They could lay off all your management people because they don't like them. And they can restructure you, and they can make culture changes any way they want it. So when you sell to third party, you are not looking to retain your people and your company culture. And you know that you are giving that up. It's a gamble. They might try to keep the culture if it is in line with the new owner, right? Founders often lose control immediately when you do a third-party sale. You don't have any say anymore. You take your money, you walk. It's almost like abandoning your child and sold it to the orphanage. That's extreme. No parents will sell kids to orphanage, but that's sort of like that. Business to me is like your own baby, and you brought it up. So it's like your baby. But when you sell it to the third party, you got to understand it is not yours anymore. So they can change any way they want it. So those are the significant changes, comparisons between the ESOP versus selling it to the third party. Why we talk about selling? ESOP is effective selling from the owner to the employee. That's why we're talking about selling. Closing and next steps. And I summarized 3 takeaways for business owners. ESOP are a qualified retirement plan that invest primarily in employer stock and can be used as a structured succession plan. Can be a liquidity tools because it gives the money to the shareholders right away. And ESOP offers significant tax advantage, yes, because it's deductible contribution and a potential 1042 deferrals in C corporation. 1042 deferral in C corporation, the simplest way to understand is you got the money that your ESOP bought the shares, but you don't have to pay taxes right away. It's a long-term capital gain, but you can defer that with more detailed rules. But you can defer. You don't have to pay the taxes right away. S corporation income shielding, because if you are S corporation, whatever money you make in the future after you have the ESOP is no longer paying taxes to your 1040. It went to ESOP to pay for the shares. So those are the benefit to the business owner. So you don't end up with your K1 every year on the S corporation anymore, and you have an ESOP, so you don't have a K1 to you personally. The K1 actually sent to the ESOP to purchase, to pay down the loans that you borrowed when you sell your shares to the employee. So that is a huge benefit as well. So overall, I just want you to know that to have the ESOP, it is a qualified retirement plan, and you can take a lot of advantage of today's taxes you are paying. You pay much less taxes or paying no taxes. So it fits. Depends on the size, profitability, employee basis, and the owner goals. So feasibility is essential. You've got to do that. You've got to do feasibility study analysis first before you step into ESOP, because we don't want you to spend all these money, then at the end say that doesn't work. So you want to do it all up front. If you are interested in doing ESOP, have a feasibility discussion with your tax, legal, and evaluation advisors. And if you come to Community CPA, we can walk you through this process to make sure that you are in the win-win situation. All right, so this is our website, communitycpa.com, and you notice that we have this on board with us button. If you click that button, and you will sign up with us 24/7 whenever you have time through this button. Then we will get back to you and get you connected with the right team member to help you out. So we have 6 partners, 2 managers listed on our website. 6 partners, we're all in different area of practice. So Dr. Hao and one of the partner, and he is legal compliance and the immigration side of work. And Dan Kim, another partner, he's in charge of client service of market development. Juan, specialty in payroll accounting, sales tax. Song, he is our attest partner, handles audit. And Derek is our IT, network architecture and IT partner. Tiffany is our tax manager. Eileen is our accounting and audit manager. And this is YouTube channel. We always deposit all of our webinars into here. And I hope that you will subscribe to our channel so you always get notified what we have for you next. And also, if you like our video, give a thumb up. Last, no responsibility disclaimer. Of course, all our webinars are for educational purposes, and it is not the tax, legal, accounting advice, because those advice need to give to you customized. We need to know who you are before we can finalize what is the advice. And be sure to review any decision with your CPA, your attorney, your tax advisor, or with community CPA before you put that in action. All right, I'll talk to you again